If you ever looked at buying a small or mid-sized business, you probably noticed something. Sellers almost always have help. A broker, an investment banker, an M&A advisor, someone packaging the story, setting the price, and running the process. And meanwhile, buyers often go it alone, thinking, I'll just find a good accountant and a lawyer when it gets serious. Today we're talking about why that's a risky way to play it, and what a dedicated M&A advisor can do when they represent the buyer. It's funny you say that, because in real estate it would sound insane. Like, sure, the seller has an agent, but I'll just figure out. Yet in business acquisitions, especially SMB deals, buyers do this all the time. Exactly. And to be clear, we're not saying attorneys and accountants aren't essential. They are, but they're not running the deal the way a buyer-side M&A advisor does. A buyer-side advisor is part strategist, part quarterback, part negotiator, part translator, and sometimes part therapist. And ideally, they're not emotionally attached to the deal. They're attached to the outcome. Perfect lead-in, impartiality. Let's start there. Buyers fall in love with deals. They meet a retiring owner, hear a great story, picture themselves taking over, and suddenly every red flag becomes a yellow flag, and every yellow flag becomes probably fine. A buyer-side advisor brings a calmer, more objective lens. Not cynical, just clear-eyed. So they're like, we can like the business and still be honest about the risks. Right. And they can say the hard things. Like, this price doesn't fit the cash flow. Or, the customer concentration here could sink you. Or, you're underwriting the owner's personality, not the business systems. Okay, let's get concrete. If I'm a buyer, what are the big buckets where an M&A advisor actually moves a needle? I'd break it into 7. Valuation and deal economics. Process management. Deal sourcing, including off-market. Negotiation. Capital and financing creativity. Diligence coordination and risk reduction. And then advocacy, being the true partner in your corner. Let's walk through them. Start with valuation, because that's where people get lost fast. Valuation is not just picking a multiple you saw online and applying it to EBITDA. In SMB deals, the quality of earnings matters. Add-backs matter. Normalization matters. Seasonality matters. And the biggest trap is confusing reported earnings with durable cash flow. And durable cash flow is what actually pays your debt and pays you. Exactly. A buyer-side M&A advisor helps you translate the business into an investable story, but from the buyer's perspective. What's a real free cash flow after realistic owner comp, maintenance capex, working capital needs, and the cost to professionalize anything that's currently living in the seller's head? So it's not just, what's it worth? It's, what can this support? Yes. What price can the business support given your financing plan, your risk tolerance, and your growth assumptions, without needing miracles? And an advisor can also help structure value. Meaning, if the seller wants a higher number, maybe the answer isn't simply yes or no. Maybe it's part cash at close, part seller note, part earnout tied to performance. Maybe a consulting agreement. Maybe working capital adjustments. You saw the gap with structure, not hope. That's where the negotiation and creativity start to overlap. Totally. But before we even get to negotiation, process management is huge. SMB acquisitions can feel chaotic. The broker is pushing a timeline. The seller is busy running the business. Documents come in drips. You're juggling your day job, lender requirements, diligence, legal drafts, insurance. A good buyer-side advisor builds a process, so you don't drown. When you say builds a process, what does that mean in plain English? It means creating a clear deal roadmap with milestones, initial thesis, target screening, first calls, NDAs, data requests, preliminary evaluation, LOI strategy, exclusivity planning, diligence work streams, financing steps, purchase agreement terms, closing checklist, and then actively managing it, following up, keeping everyone aligned, preventing the deal from dying of confusion. That dying of confusion line is real. Deals don't just blow up from one big issue. They also die from 50 small delays. Exactly. Momentum matters, but so does discipline. And that's the balance. Move fast enough to keep the seller engaged, but not so fast that you skip the work that protects you. Now, the part buyers get excited about, deal sourcing, especially off-market. Is that really a thing for SMB? It is, and it's often misunderstood. Off-market doesn't mean cheap by default. It means less crowded. You're not one of 40 bidders in a broker process. It might be a business owner who hasn't formally decided to sell, but would consider it if approached the right way with the right message. So the advisor helps you hunt rather than just shop. Exactly. A buyer-side advisor can help clarify your acquisition criteria, build a targeted outreach plan, tap industry networks, connect with centers of influence like CPAs and attorneys, and approach owners in a way that feels respectful and credible, not spammy. Because in SMB, trust is currency. And if someone is selling quietly, they're probably sensitive about employees or customers finding out, right? So discretion is vital. Buyers who don't know how to handle that can unintentionally spook a seller or create rumors. Advisors can help design the approach and manage confidentiality carefully. Okay, so we found a deal. Now negotiation. Everyone thinks they can negotiate, but business acquisition negotiation feels different than negotiating, say, a salary. Yes, because it's multidimensional. It's price, terms, reps and warranties, indemnities, working capital targets, transition support, non-competes, training, customer handoffs, who pays which fees. What happens if something changes before close? A buyer-side advisor helps keep you focused on what actually matters to your risk and returns, and also helps you not get baited into ego fights. That's huge. Sellers sometimes interpret questions as accusations. Buyers sometimes interpret defensiveness as dishonesty. An advisor can lower the temperature. They can say, "This is standard," and mean it. They can frame requests in a way that preserves goodwill while still protecting the buyer. Let's talk about capital innovation, because that phrase gets thrown around. What does it look like on real SMB deals? It's the art of building a financing stack that closes the deal while keeping the business healthy. Perhaps you're using a conventional bank loan, perhaps SBA financing, maybe a blend, senior debt plus a seller note. Maybe you bring in an equity partner. Maybe you negotiate an earnout to reduce upfront cash. Maybe you defer some CAPEX via a planned equipment lease. The advisor helps you explore options and compare trade-offs. Trade-offs like personal guarantees, dilution, covenants, and how much cash you'll have left for working capital and growth. Exactly. Too many buyers focus only on, can I get this loan approved, instead of what is this capital structure due to the first 24 months of the business? If you over-leverage, you can win the deal and lose the business. How does the advisor interface with lenders and investors? They can help package the deal so financing parties understand it. The business model, drivers of profitability, customer retention, the transition plan, and the risk mitigations. They can also help the buyer respond quickly to lender questions and keep the financing timeline aligned with LOI and closing. All right, now diligence. People hear due diligence and think of the checklist, but it's more like an investigation, right? Exactly. Diligence is not about collecting documents to feel busy. It's about reducing uncertainty. A buyer-side advisor helps decide what questions matter, which risks are acceptable, and which ones require price adjustment, a term, or you walking away. Can you give examples of the kinds of things that come up in SMB diligence? Sure. Revenue quality. Are sales repeatable or one-off? Customer concentration. What happens if the top client leaves? Vendor dependence. Is there a single supplier with leverage? Operational dependence. Does the owner do everything? Employee stability. Are key people likely to stay? Compliance. Are licenses current? Financial cleanliness. Are the books consistent with the tax returns? And then the subtle stuff, like whether the culture can survive the transition. And advisors coordinate, because otherwise the buyer is fielding accountants, lawyers, insurance brokers, lenders, maybe an IT consultant, all asking for things. Right. Coordination is underrated. The advisor can make sure the diligence streams talk to each other, and that findings flow into negotiation. Because the point isn't to discover issues and then shrug. The point is to convert issues into decisions. Now, the last bucket you mentioned, advocacy. Being a true partner. That sounds a bit intangible. It's intangible until you're in the middle of a stressful deal. Buyer representation means someone is waking up every day thinking, what is best for this buyer? Not what's fastest, not what earns the quickest fee, not what makes the seller happy. A real buyer-side advisor combines fierce will with humility. They push on what matters, but they also listen, because sometimes a buyer is wrong or the market is telling you something you don't want to hear. I like that phrase, fierce will and humility. It's aggressive about the goal, but careful about the ego. Exactly. And advocacy also means helping buyers build confidence, not artificial confidence. Real confidence grounded in numbers, structure, and a plan. It's one thing to buy a business. It's another to buy a business and still sleep at night. Let's address the obvious pushback. Doesn't hiring a buyer-side M&A advisor add cost? How does a buyer justify it? It does add cost. But the more relevant question is, what's the cost of a mistake? Overpaying by 10% can be life-changing in SMB. Missing a working capital trap can create an immediate cash crisis. Poor terms can leave you exposed to liabilities you didn't price in. A strong advisor can pay for themselves by improving price, improving terms, sourcing better deals, and saving time, sometimes months. And time is not just time. It's opportunity cost and emotional bandwidth. Exactly. Also, not every buyer needs the same level of support. A first-time buyer doing a search while working full-time might need full process leadership. A sophisticated strategic buyer might want targeted help, valuation, negotiation support, and deal sourcing. The point is, buyer representation is flexible, but the value proposition is consistent. Before we wrap, can we talk about different buyer types? You mentioned individual buyers, strategic buyers, and financial buyers. How does the advisor's role change? Great question. For an individual buyer, like a first-time entrepreneur through acquisition, the advisor often acts like a guide, tightening criteria, preventing overreach, helping build lender-ready narratives, and negotiating a transition plan that sets the buyer up to operate day one. For a strategic buyer, say an existing company buying a competitor or adjacent business, the advisor can focus on synergy validation, integration considerations, and negotiation that protects the strategic value without overpaying for it. And for a financial buyer like an independent sponsor or small private equity group, the advisor can help with pipeline building, structured offers, and disciplined underwriting, plus moving faster with repeatable process. So the toolkit is similar, but the emphasis changes based on what winning means for that buyer. Exactly. And the best advisors know that. They don't force every deal into the same template. Let's land the plane. If someone is listening and thinking, okay, I'm a buyer, I should consider an advisor. What's the first step? Start by getting clear about two things: your acquisition thesis and your constraints. What industries interest you? What size range? What level of owner involvement do you want? What's your budget, your timeline, your risk tolerance? A buyer-side advisor can help refine that, but you'll move faster if you've done some self-assessment. And then interview advisors like you would a key hire. Yes, ask how they source deals. Ask what their process looks like. Ask for examples of how they've improved terms, not just closed deals. Ask how they work with attorneys, accountants, and lenders. And ask a big one. Will they tell you to walk away when it's the right call? Because the best buyer advocate is the one who can say, not this one, even if it's exciting. Exactly. In SMB acquisitions, avoiding a bad deal is as valuable as closing a good one. So the takeaway is simple. Sellers rarely go unrepresented, and buyers shouldn't either. A buyer-side M&A advisor can help you value the deal correctly, run a competent process, source opportunities, especially off-market, negotiate intelligently, build creative financing, coordinate diligence, and stay objective. And do it as a true partner, driven but grounded. Fierce will, humility, and a focus on your outcome. That's what buyer representation is supposed to look like. All right, that's it for today. If you're out there searching, underwriting, negotiating, or just daydreaming about buying your first business, remember, you're not just buying cash flow. You're buying a future. Build the team that helps you protect it.